we've been waiting to hear what BHP was going to do with their shale business. We haven't heard from them since October, and I think oil prices were about $80, and now they're at 50. So they've come out and said we're cutting the number of drill rigs we have operating by 40% in the US, and that shows a couple of things. It shows they're really focusing on keeping their free cash flow and trying to reduce spending, which we knew they were doing, but this is more dramatic. They're also one of the lowest cost producers in the States. They're in some really good spots, so it shows that the cuts that are happening in the States are happening. They're widespread, and so there's a real supply response happening in the US.
Right, and it would also indicate that they expect these market conditions to persist for a little while if they're starting to wind back a bit.
Expected, or at least preparing for it. I mean, I'm sure they wouldn't say they're forecasting prolonged periods of low prices, but they're definitely preparing for that to happen. Andrew Mackenzie, in his comments in the quarterly, said that they might have to take more action. What they've done is they've cut their drill rigs mainly in an area called the Permian in Texas, which was more a sort of frontier, early stage area for them, and they're going to focus on an area called the Black Hawk, which is pretty much the sweetest spot for shale in the US, and it's where they spent a lot of money getting into when they bought Petrohawk in 2011. The Permian was like an added bonus. But what Mackenzie said was that there's the chance that they may do further cutbacks in the Black Hawk. So that really shows you that the US shale is cutting back in some of its best areas.
So is there any indication as to what kind of market forces would have to, push BHP to make those further cuts? Would just these oil prices staying low be enough?
Oh, you'd think so if they stayed long low enough. For BHP, there's other considerations as well. I mean, it's not just they're not just going to keep producing this while they make a return on it, because their cash flow is being hit all across. Iron ore prices are down, oil prices are down, coal's been down for a while, and copper's down. And what they're actually struggling to do now is meet their commitments to keep an A-grade credit rating, which they need obviously to keep their debt and asset ratios at a certain level and cash flow, and also keep providing what they call their progressive dividend, which is a commitment to increase their dividend every year for shareholders. So to do that, they actually have to conserve spending a bit. So what they're also trying to manage that. So that's another consideration. So a bit more might come into it as far as what BHP does to cut further production or whatever.
Yeah, now maintaining some of that cash flow to provide a dividend, there has been a little bit of speculation about that since these results have come out. Do you think that's a healthy thing for the company to be doing, to be keeping money from production and giving it back to their shareholders?
I guess it's a fine line that the board has to look at, and what they're doing in the States, I mean, that's the same as many producers over there are doing. So I think you can't pinpoint that on a sort of a drastic move to maintain dividends. But yeah, I mean, one of the strengths that BHP has had recently, and especially that helps its low share price, is that it's actually offering quite a good dividend, quite a good yield, and so as long as they've got that commitment to a aggressive dividend, people should feel safe buying BHP stock and counting on the dividend at a certain level. So yeah, they really have to weigh up. That it's a really important factor that they do keep that going. Yeah.
Terrific. Now, just finally on iron ore, it obviously is another significant element of this report, and production keeps flying up. Was there anything surprising in there?
No, not really. It was a little bit under what some of the analysts have been expecting, but no, all their targets were maintained, and they're pushing ahead with their growth projects. BHP and Rio, they're very low costs. So even though they're flooding this market, which is already oversupplied, they're making easily 50% margins at the moment. So these expansions for them will be profitable. It means more pain for other producers, and I think we're going to see prices come down a bit lower. There's been a few things happening in the iron ore market. UBS came out and downgraded forecasts yesterday, saying that China hadn't performed as well as they'd hoped in the new year. And also costs are coming down, oil prices, currency is all helping the miners, so that's putting further pressure on the price, but it's good for margins.
Right on. Matt Chambers, thanks very much.
Thanks, Eric.